Hi everyone, let's talk about LLCs and LLPs. In this chapter, we're going to define what a limited liability partnership is. We're going to describe the liability of an LLP and its partners. We'll do the same thing with LLCs, defining what they are and looking at the process of organizing and the liability that the organization and its members have. We'll compare the management of a member-managed versus a manager-managed LLC. We'll determine when members and managers owe fiduciary duties of loyalty and care to an LLC. And we'll describe the dissociation of members and the dissolution and winding up of an LLC. All that means we're going to be looking at the ins and outs, the basics of LLPs and LLCs. So I think it's helpful to start off by questioning or examining why we have all these different forms of business ownership. You got sole proprietorships, partnerships, LLCs, LLPs, corporations, S-corps. Why all these different forms? Well, they usually have different implications for who can own them, how many members or partners can there be. Some of the biggest concerns are usually taxation, the way the organization and its members are taxed, as well as liability, meaning what kind of personal liability might the business owners, partners, members have. So all these different forms of business ownership are ways to manipulate those aspects of a business. And it's a good idea to know ahead of time, how is taxation going to work? What kind of liability am I going to have before you start a business or buy into a business? So that's why we're doing all this. We'll start off with an LLP, a limited liability partnership. So we've talked about general partnerships before. All the general partners have unlimited liability, and so you have to use some creative tactics to try to shield your personal assets, like incorporating yourself before becoming a member of a partnership, things like that. An LLP is a way to eliminate this type of shielding yourself from liability, because the organization itself gives the limited liability. So it's a special form of partnership in which all members are limited partners. There are no general partners. Okay, so every partner is going to have limited liability, meaning it's limited to the amount of money that I put into the business. And they're not going to come after my personal house and my personal possessions unless I've committed an intentional tort or am guilty of some kind of grievous wrongdoing. But in most instances, for just normal business operations, I'm not going to be personally liable. LLPs are used most often. We see these a lot in certain types of professional work. So accountants, lawyers, doctors are common organizations in which we see limited liability partnerships. And it's easy to understand why. You know, if you start a doctor's office, you don't want to be personally liable if one of your partners commits malpractice and everybody gets sued for millions of dollars. So you'd like to, have all the benefits of a partnership without some of those drawbacks. So there is a Uniform Limited Liability Partnership Act, and there are amendments to it. Depending on which state you live in will determine which version of this legislation your state has adopted, if any. I give you a link there to North Carolina's version of the Uniform Partnership Act that also covers LLPs. So if you're interested, check that out and read it. It's pretty interesting. The reality of the situation is that if you're going out and starting an LLP, what you're probably going to be doing is working closely with an attorney who can advise you on the ins and outs of our state's laws, whatever state you're organizing in, and can give you better advice than you trying to read the statutes by yourself. So how do we form an LLP? Well, they're creatures of state law. So we formed them by filing articles of limited partnership or a statement of qualification, which are known as commonly articles, with the Secretary of State in the state in which the LLP is being organized. Then the LLP can amend those articles by filing an amendment with the state. Okay. So the articles are usually just going to say, well, who are the partners? What are we doing? What kind of profession are we involved in? And just basic information like that. Then it's registered with the state. The partnership is going to be governed by the laws of the state in which it was organized. Now, if you conduct business in another state, you still have to abide by that state's laws regarding business and operations, but internal management is going to be governed by the laws of the state in which you organize. The name of an LLP can be really anything. It can be the name of the members or anything else you decide, but the law does provide that you have to use certain terminology when forming your business. So RLLP or LLP in some form has to be there so that people are aware of the type of business organization they're dealing with. If you're going to operate under a name other than who the partners are, you have to file a DBA like we saw with other kinds of partnerships. The Limited Liability Partnership Agreement is something you're going to want to spend a lot of time on. It's going to spell out the rules for how the company is going to be managed, who has management authority, how do you distribute profits, how do you take votes, does one person have more voting authority than another person, things like that. Spend a lot of time on that. That settles a lot of problems ahead of time. Now, if you don't spend a lot of time on it, and if your partnership agreement leaves out something that would be important, then it's going to go to state law. And if you're not well versed with state law, you might be surprised at the rules that take over if a dispute arises. So, good idea. Spend a lot of time creating a really good, solid partnership agreement ahead of time. Taxation. We have flow-through tax benefit, also known as pass-through taxation. All that means is that the partnership as an entity isn't taxed. The profits that are distributed to the partners just are taxed at their individual income tax rate. As far as management and profit share go, like I said earlier, hopefully you address this in your partnership agreement to spell out exactly how you're going to handle management and profit share. Now, if you don't do that, then again, those state laws are going to become the default. The default is usually that each partner of an LLP has an equal right for management and conduct of business. The caveat there being unless we agree otherwise. And then a simple majority would decide most ordinary partnership matters unless it's something that's crucially important. And again, we can define how that stuff is going to be decided in the agreement. Each partner also has an equal right by default to share in the profits. And if you want that to be different, you have to state it in the partnership agreement. Liability. Okay, so this is a huge concern. Obviously, if you're an accountant or a doctor or an attorney or whatever you are, there's always the possibility that somebody commits some type of tort or you get sued for some reason and you're facing a lot of money in damages. Possibly, depending on the type of business ownership you have, that liability could go down to the individual person. But if we structure the LLP correctly, and as long as we're not doing things that are intentionally wrong, probably what we're going to find is that the entity itself, the LLP, the partnership, will be liable for loss and injury caused by tortious conduct of partners, as long as they're acting in the ordinary course of business or with authority of the partnership. And what that does is just spell out that as long as somebody's not doing something grievously illegal or just crazy reckless, then the entity itself will be liable. But what if the entity didn't have enough money to pay out? So somebody sues us for $10 million and they win a judgment. The organization only has $500,000. Well, they can get that $500,000 of assets, and then the remainder would just be not able to be recovered. You can't then go after the individual members again, unless I can prove that they were doing something reckless or illegal or something like that. As far as contracts, an LLP, of course, is going to be liable for contracts entered into on behalf of the partnership. This is something you'll want to address in the partnership agreement as well. Can one person go out and bind all the other partners to a contract, or does it have to go to a majority vote, or how are you going to handle that? By default, any one of the members could go out and form a contract and bind the partnership to it. So if you don't want it to be that way, you should address it. Okay, so that's the liability of the partnership organization, but how about the partners? Okay, so as far as business debts and obligations, unless they're personally at fault, no partner is going to be liable beyond their capital contribution. As far as professional malpractice goes, well, the LLP business form is going to protect partners from vicarious liability for other partners' professional malpractice, but it doesn't shield the individual who is guilty of malpractice or liable for malpractice from their own liability. So I can still be held personally liable for my own conduct, but the other partners wouldn't then be liable for my misconduct. Okay, so this is just an exhibit that sort of demonstrates, maybe it's helpful, maybe it's not, but it just gives you a visualization there. So we have the LLP, this is the business organization, the blue box, and then we have an arrow designating or showing that we're, of course, going to be dealing with all sorts of third parties, clients, the general public, whatever. Now, each one of the partners puts some type of capital investment into the partnership. We're all considered to be limited partners. Our liability is going to be limited to the amount of our capital contribution into the organization. So it's kind of like being a shareholder in a corporation. I might own a couple shares of Microsoft, but if Microsoft gets sued for $1 billion, I don't have to pay that judgment. I'll just lose whatever stock value I lose. So no personal liability for the partnership's debts and obligations for the limited partners. Continuation agreement is a good idea. Maybe we set a term limit for how long the partnership is going to continue or how long it's going to exist. And then if we want it to continue beyond that, we have to have a continuation agreement. You can have partnerships at will, meaning they exist forever as long as we decide we want to keep doing business, or you can have those term partnerships. And if you have a term partnership and you decide later you want to continue, then you would have to have a continuation agreement. Switching gears a little bit, those LLPs, limited liability partnerships. Now we're switching over to limited liability companies, or LLCs. And most of us are probably familiar, at least with this terminology. We've heard of an LLC before, even though we might not understand what exactly it is. So it's an unincorporated business entity that seeks to combine the most favorable attributes of general partnerships, limited partnerships, and corporations. So LLCs are separate legal entities and creatures of statute. They have the same powers as individuals to do all things necessary or convenient to carry on its business or affairs. An owner of an LLC is called a member. So instead of having shareholders or owners, we would just call them members. Now, this is, again, what we're trying to do is balance here the benefits of individual business ownership with the liability shield of something like a corporation. And as long as we meet the requirements, then we can form an LLC. One big difference is that one person can start an LLC. You don't have to have two or more members. You can have as many members as you want, or you can just be one person and start an LLC. There is in existence a Uniform Limited Liability Company Act, known as the ULLCA. I give you a link there to North Carolina's adopted version of the Limited Liability Company Act. So again, you can check that out if you'd like to. And again, if you're going to start an LLC, I highly recommend working with an attorney, if for nothing else than just some advice on what kind of business ownership form your business should take and the things you need to think about before choosing a form of business ownership. Okay, so LLCs are separate legal entities that are distinct from their members. The LLC as a company is considered to be a person in and of itself. We call it an artificial person, whereas you and I as natural people are considered to be natural persons. The LLC as an entity does have the same powers as an individual to do all things necessary or convenient to carry on its business or its affairs. LLCs, I'm having trouble with my words today, folks. I apologize. The LLCs are taxed as partnerships. There's a caveat there. But first, that means that we have that pass through or flow through taxation benefit that we talk about with certain forms of business, meaning that rather than the entity itself being taxed on the company's earnings are distributed out to members, and then the members themselves pay on their individual tax forms. Now, the LLC does offer this feature that is, I think, unique to LLCs, where you can elect to be taxed as a corporation if you choose to do so. The ins and outs of which form of taxation you would want to choose is something that you really should discuss with a CPA, with an accountant, to try to figure out. It's going to depend on how much money are you earning, what are the ways in which you distribute that money out to the members. Is it as normal distributions they would claim as being normal wage income, or would it be as dividends, things like that are going to determine which form of taxation you choose for your company. So again, work with an accountant to help you analyze what would be the best way for your business to operate. Like I said earlier, an LLC can be organized by one person alone or many people. A person here, we're going to define person as being either a natural or artificial person. So partnerships can be members of LLCs, corporations can be members of LLCs. It really opens it up to a wide variety of different natural and artificial persons that can be members of an LLC. Depending on which state you live in, your state laws might prohibit certain professional groups, such as accountants, lawyers, or doctors, from operating as LLCs. In North Carolina, they can. It would be known as a professional LLC or a PLLC. An LLC can be organized in only one state, even though it can conduct business in all other states. So then the same thing would apply to an LLC as with partnerships and other business organizations. As far as managing your own business, you would have to follow the laws of your state as well as the agreement that you'll sign later on. But when you're operating in other states, as far as business operations in that state go, you have to obey that state's laws when operating there. When you name it, you can name it whatever you want to, as long as it's not already taken or too similar to another business's name. But you do have to include either the words limited liability company or the initials LLC or LC. Your articles of organization are the documents that you file with the Secretary of State's office in order to organize and form the LLC. It is known as a domestic LLC in the state in which it is organized, and then a foreign LLC in every other state. The articles of organization are called certificates of organization. Depending on which state you file in, they're called articles here in North Carolina. This is a very extremely simplified example of one might look like, but just contains the necessary information in order to form it. So you have the name of the company, the address, the duration. If you're going to specify a duration, you don't have to. And then who is the manager. Speaking of duration, by default, they're at will, meaning that there is no specified duration and they can operate in perpetuity. However, if you choose to specify a term of duration, it would become a term LLC, and then the LLC would terminate at the end of that duration. Capital contributions can take many different forms. It can be straight up money, it can be personal property, real property, other tangible or intangible property. It can be services that you perform. It can be contracts for services to be performed. It can be promissory notes. So it can really take a lot of different forms as far as a member's capital contribution to an LLC. You might specify that when somebody contributes, that they get a certificate of interest, which would be a document that would evidence a member's ownership interest in an LLC. A distributable, if I can say it correctly. Again, I don't know why I'm having such a hard time speaking today. Distributable interest is a member's ownership interest in an LLC. I don't know if you noticed on the video, but I had to do a little ninja edit because I saw a spelling error in my slide. But anyway, a member's distributable interest in an LLC is considered to be personal property and may be transferred in whole or in part unless restricted by the LLC. So similar to partnerships, you'll have an agreement, an operating agreement for the LLC, and that will determine, you get to set out your rules about how you want things to work. What are the rules of this LLC going to be? So you can specify, under which circumstances or how can a member transfer, sell, whatever, their ownership interest in the LLC. So a transfer of an interest in an LLC does not entitle the transferee to become a member of the LLC or to exercise any right of a member. So just because I sell my ownership interest in an LLC doesn't mean they automatically become a member of the LLC or get to have a say in, how it's managed or something like that. In order for somebody to become a member of an LLC, we have to have usually a unanimous vote of the other members to introduce another member in. But again, you can say in your operating agreement how you want those rules to go. So as far as sharing profits and other distributions, you can agree in your operating agreement how you want that to work. Does everybody get an equal share? Or is it based on the amount that they contribute? How is it going to work? If you don't have it specified in your agreement, it's going to default back to state law. So you'd have to go back and review your state's laws to understand how it's going to flow. It can vary pretty widely depending on how your state adopted and crafted and modified those laws. Like I said earlier, the operating agreement, very similar to the partnership agreement that you would have in a partnership, but it's the contract that we enter into that governs the affairs and the management and the profit distribution and how to admit new members and how to dissociate a member, things like that, that are really going to be the rule book for how the LLC operates. And then once you have specified that, that takes precedence over your state laws, unless we're acting illegally in some way. The big problem and where the state laws really come in is if I didn't specify something or if it was too vague to be interpreted, then it'll default back to the state laws. As far as liability goes, an LLC is liable for any loss or injury caused to anyone as a result of a wrongful act or omission by a member, manager, agent, or employee of the LLC. So the entity itself, the company, will be liable for tortious conduct or whatever of all those people. That's the business. Again, that's different from the members. We'll look at the members next. And we also have to specify while acting within the ordinary course of business. So if somebody is acting way out of pocket, then maybe the LLC isn't liable and maybe it's the individual member or agent or employee or whatever that would be liable instead. So how about the members? We talked about the liability of the LLC itself. So how about the general members? The general rule is that the members are not personally liable to third parties for the debts, obligations, and liabilities of an LLC beyond their own capital contribution. So whatever I put in the business, those are business assets now. Those are up for grabs if the business gets sued, but my own personal property wouldn't be on the line. Now there are some exceptions. So if we find that the member is abusing the LLC form in some way, that would be a determination by a court. Then what the court can do is what they call piercing the corporate veil in order to go after a member's personal assets. So that can happen, rarely, but it can. If members, managers, or employees of an LLC, while acting on behalf of the LLC, either intentionally or negligently injure someone, they are personally liable for those injuries and damages that are caused by their conduct. Okay, so if I individually am the one who intentionally or negligently injures someone, The other members in the organization wouldn't be personally liable, but I potentially could be. That's a graph that shows what's pretty much the exact same thing as the one we saw earlier for limited liability partnerships. The big difference just being that it's a different form of ownership, and there are different default state rules that go into it. And it can be started by one person. It's considered to be a company, an entity in and of itself. But the basic idea and the basic protections are pretty similar across the two forms. So the liability for a member, instead of being a partner, they're called members, would be limited to their capital contribution. No personal liability for the company's debts and obligations. So there was a case here where 5 people formed an LLC to start a bar and leased a commercial space. Later on, the company defaulted and had no assets, went out of business, and stopped paying the lease, obviously, at that point. So the owner of the commercial property sues one of the members, Richard Hess, saying that he should be personally liable to honoring the rest of the lease agreement. So then the question became before the court, should he be forced to be personally liable? And the court said no. There was no evidence that he did something illegal or egregious or something that would cause him to be personally liable. So, they could go after company assets, of which there are none. And then after that, the property owner is just kind of out of luck at that point. As far as management of an LLC, you can have member managed or manager managed LLCs. And a member managed, the LLC is managed by its members, as the name would suggest. And this is the default form of an LLC. For a manager managed, the members designate certain members, or it could be a non-member, to manage the LLC. It's then managed by the designated managers. And then non-manager members no longer have the right to manage the LLC. So that the long and short of it is that we would go in and designate in the operating agreement who is going to have management authority. Then those people have authority and the other people don't. So not too hard to understand. There are, however, certain actions that cannot be delegated to managers and must be voted on by all members. Like, and I give you a list of examples here, this isn't all of them, but some examples: amending the articles, amending the operating agreement, admitting a new member, dissolving the LLC, or merging with another company would have to have the vote of all the members. When talking about agency authority to bind an LLC to a contract, we're talking about, well, exactly that. Who has the authority and the ability to sign a binding contract that binds the LLC to that agreement? Well, it depends, and it's best handled in your operating agreement to specify who does. If we're looking at defaults, well, some of the defaults can be, if it's a member-managed LLC, the default is that all members have agency authority to bind the LLC to a contract. Under revised versions that were dreamed up later on, a member has to be given agency authority to bind an LLC. If we're talking about a manager-managed, then the managers, the people who are designated to have management authority, do have the authority to bind the LLC to contracts, but non-manager members don't. Again, those are the defaults. So if you want yours to operate a specific way, just be clear about it in the operating agreement. Fiduciary duties of members of an LLC. Okay, members of member-managed LLCs and managers of manager-managed LLCs owe a couple duties. One is the duty of loyalty. They have to be honest in their dealings with the LLC and not act in ways that are adverse to the interests of the LLC. So I shouldn't be competing with them or making secret contracts that benefit me to the detriment of the LLC, things like that. I have to be loyal to the company. And I have a duty of limited care, so I must not commit a known violation of law or intentionally, recklessly, or grossly, negligently injure the LLC or members. Now, excluded from that is just ordinary negligence. Now, people make mistakes sometimes, and it doesn't mean that they were being hostile or anything like that. Sometimes you just make a bad business decision. But as long as I'm not being those key words up there, intentional, reckless, grossly negligent, then I'll be okay. But if they find that I violated my duty of limited care, then I can be personally liable. There is no fiduciary duty owed when a member of a manager-managed LLC who is not a manager. I don't owe that fiduciary duty of loyalty. So the people that owe that duty of loyalty are the people who are either member-managed or the managers in a manager-managed LLC. But if I'm a non-managing member of a manager-managed LLC, in other words, this terminology can be confusing when you say member so many times, but if I'm a member of an LLC and I don't have management authority, then I don't owe that fiduciary duty of loyalty or care. I become kind of like a shareholder in a corporation. I can pursue my own business interests outside of what the LLC is doing, and that would be fine, since I'm not in management authority for the LLC. What are some advantages? We've gone over some of this stuff, but this is probably the most popular new business form of ownership. Sole proprietorship is probably the most numerous, and then LLCs are catching on real quickly because people see the advantages for taxation and liability purposes. But the major advantages, it provides that limited liability, key. It gives owners the ability to manage the business, great. It provides owners with the authority to designate professional managers to manage the business, equivalent to managers of corporations. So maybe I want to take a step back from the actual operations and hand that off to somebody else, and maybe I go live a really nice, quiet life where I get the money, but somebody else handles the day-to-day management of a business. The LLC would allow for that. And like I said, the taxation, the flow-through or pass-through taxation, like a partnership, but I could also designate to be taxed by a corporation. So it gives you some flexibility there. It doesn't have we haven't gone over S corporations yet, but we will. But we'll find later that they have some limitations on the number of owners and the type of people, type of persons that can be owners of an S corp. Let's talk about if a member wants out. That would be a dissociation of a member if a member wants out of the LLC. Generally, members have the power to withdraw from the LLC, of course, unless I state otherwise in the operating agreement. So again, we can create our own rules within the operating agreement. For an at-will LLC, generally, withdrawal of a member is called a dissociation, and the dissociating member must be paid the fair value of their interest, whatever their ownership interest in the company is. They would have to be paid fair value for that. In updated versions, which I'm pretty sure North Carolina has not adopted, the LLC would not be required to purchase their ownership share, in order to buy them out, but they would still have to pay them their profit share. So again, these are default rules, and it's a good idea to work closely with an attorney if you're forming an LLC with other people to specify how a member could leave if they chose to leave. Do I have to completely buy them out, or are they allowed just to leave and I don't have to pay them, half the company's value, but I just still have to keep paying them the profit share that they would be entitled to? And once they withdraw, then they no longer have management authority, or, however you want it to be handled. Be clear about it, and that will avoid some conflict later on, hopefully. For a term LLC, the LLC does continue in its business. The withdrawing member is then paid the liquidation value of their interest on the date of expiration of the term. So if a member withdraws, they don't get paid out right away. They would get paid out at the expiration of the term whenever the business is going to be wound up and dissolved. Wrongful dissociation. When a member withdraws from a term LLC prior to the expiration of the term or accomplishment of the objective, however we set up the term, if it's a term LLC, then the member could potentially be held liable for any damages that are caused, if it does cause damages. Maybe a business is dealing with us because of one particular partner or one particular member, and then that member backs out, and then the business terminates the contract or doesn't renew the contract or whatever. Then that would be a specific damage we could point to and say this person should be liable for this damage caused to the LLC. And then I gave you a quick link there to, in North Carolina, what are the rules for cessation of membership. We didn't call it dissociation in our statutes. We called it cessation. Okay, dissolution of an LLC. Now we're talking about winding up and terminating the LLC so that it no longer exists. So there are certain things that can happen to dissolve an LLC. Some of those things are the expiration of a term, if it's a term LLC. All the members could vote and consent to dissolve the LLC. We could, if we stated in the operating agreement that it only takes certain members to vote, then that vote would do it too. If a certain event occurs that we agreed to ahead of time, if a court orders that the company has to be dissolved, this again happens very rarely, but if they find that some company is really just cheating people or operating completely recklessly or outside of the law, maybe then the company just doesn't get the opportunity to exist anymore in that state. A state may administratively dissolve an LLC if it does not pay state taxes or fees when they are due, or if it fails to file its annual report with the state. Again, it's pretty rare that a state would order the dissolution of an LLC, but it can happen. Winding up just means that, we've decided to dissolve. We're going to try to settle up with everybody that we can. And once we've settled up, then the company would be dissolved. But we're looking at gathering, preserving, and selling the assets of the LLC and then distributing that money to creditors. And then if there's anything left to the members, once everything is said and done, I can then file articles of termination or a certificate of termination, depending on what your state calls it, with the Secretary of State where I organized, just notifying them that the company is being terminated. If we were to decide to continue, then we could have a continuation agreement. Maybe it's a good idea if you set out a term, but then you sort of form a backup plan in case you don't want the LLC to terminate. And then finally, we talk about PLLCs, which is a way for professionals to form an LLC, a special form called a PLLC. We see these sometimes with certain professions like attorneys or doctors or accountants. Just another one of these business forms that allow this usually pass-through taxation and limited liability just under a different business organizations. And in those, like we discussed before, members would still be liable for their own malpractice, but generally the business structure prevents a member from the malpractice of another member of the PLLC. Well, that wraps it up for this lesson. If you have questions, of course, feel free to reach out to me. Otherwise, have a great day.